the Fed has guaranteed or loaned money to, or both, all the big banks, the primary dealers. They've guaranteed the money market funds. They've guaranteed the commercial paper market. They've guaranteed the corporate bond market, the municipal bond market. It's hard to think of anything they haven't guaranteed. And, our Congress recently in the past, and the president signed a $2.2 trillion rescue package, if you want to call it that. But buried inside the $2.2 trillion of spending, there was $450 billion earmarked to recapitalize the Fed. So the Treasury is giving money to the Federal Reserve to, in effect, rescue the Federal Reserve's balance sheet. But the Federal Reserve is a bank, so they can take that new money and leverage it 10-1, and they will. So the $425 billion of new capital will be turned into about $4.5 trillion of asset purchases. Now, the Fed balance sheet today is about $5 trillion, which is significantly higher than it was at the end of QE3. At the end of QE3 in 2014, the Fed balance sheet was about just under $4.5 trillion. Today, it's $5 trillion. But they're going to have another, about $4.5 trillion on top of that as a result of this new capital and all the new programs. So they're going to get their balance sheet close to $10 trillion, which is almost 50% of the entire gross domestic product of the United States, which is around a little over $20 trillion, about $21 trillion. So what does it mean when the central bank has a balance sheet equal to half the entire GDP of the country for an entire year? We've never seen anything like it. I guess we're going to find out, because I always said the Fed bailed out everybody else. The Fed bailed out banks, primary dealers, money markets, commercial paper, corporate bonds, municipal bonds. Who bails out the Fed? And we now know the answer, which is the U.S. Treasury, which means the U.S. taxpayer will have to bear the cost of this. But let's see if it works. I mean, they are going to do it. So everything I just described is happening. The question is, will it work? This is not stimulus. The idea that all this new money printing, asset purchases, guarantees, etc., will stimulate the economy is false. It will keep the lights on. The Fed is keeping the lights on. So they're providing liquidity. They're keeping the payment channels open. They're keeping the plumbing of the financial system operating. They're trying to avoid failures of banks, which they have so far been able to do. So, as I said, they're keeping the lights on, but they're not doing more than that. There's nothing stimulative about this. For that matter, the remainder of the $2.2 trillion spending plan, there is no stimulus. There is spending. Yes, they will spend the money, but it will not give the economy a boost. In fact, we might not even get $1 worth of GDP for each dollar of spending. Yeah, you might borrow $1, spend $1, and get 90 cents worth of GDP. So not only are you not getting a Keynesian multiplier of 1.2 or 1.3, you're probably getting something more like 0.9. In other words, less than $1 of GDP for every dollar spending. And there are reasons for that, as shown by Carmen Reinhart and Ken Rogoff in their research, because people expect inflation, they expect higher taxes down the road, but one way or the other, people don't spend the money. They save it, they pay down debt, they reduce their balance sheets, and they kind of get ready for worse to come. So yes, we have a couple $1 trillion of spending, but it's not stimulus. And we're probably going to have upwards of $5 trillion of money printing, but it's not stimulus. Everything I just described is no more than a patchwork to keep the lights on and keep the economy going, but it won't get us out of our problems. This is the first economic shock that most economists can think of that was both a supply shock and a demand shock. For example, in the 1970s, we had a supply shock where OPEC, cut off oil exports to the United States and quadrupled the price. And we had gas lines in the United States. You had to line up for hours sometimes to get gas in your car. So that was a supply shock with predictable consequences in terms of prices and inflation and so forth. In 2008, for example, we had a demand shock because unemployment skyrocketed, banks failed, people lost their jobs, people lost their homes, et cetera. So even though the supply side of the economy was fine, people weren't spending. But this is both. This was a supply shock in the sense that China had to shut down to deal with the virus and could not provide components or inputs in the supply chain. So you could have a U.S. factory, for example, that was taking imports from China and then assembling them or combining them with other imports to produce finished products. Well, they couldn't get those supplies. Vessels were not leaving China. People didn't want to unload the vessels, et cetera. Now, little by little, China has been able to kind of reopened the economy. I think it's overstated. I don't think that China's economy is anywhere near as open and productive as it was, but it's reopening stages. But now we have a demand shock where it doesn't matter what China can make. Nobody wants it. Nobody has the money. U.S. unemployment is skyrocketing. U.S. factories are shut down because of the virus. U.S. consumers are locked in their homes. And so maybe China can make things, but nobody wants them. So this is both a supply shock and a demand shock. It's extreme. I think people looking at 2008, the global financial crisis, even 1998 with Russia, we go back to 1994 with Mexico, etc. None of these crises are good baselines. If you want to understand what's going on now, you have to go back to 1929. You have to go back to the Great Depression. Of course, in the Great Depression, unemployment went to 25%. We may see unemployment in the United States perhaps reach 25%. But here's the difference. The Great Depression played out in stages, but the 25% unemployment and the 90% drop in the stock market played out over 3 years between 1929 and 1933. Here, everything happened in 3 weeks. So we not only have this simultaneous supply and demand shock, which we've never seen before, but we've never seen movements in prices and stock market indices and unemployment, et cetera, that happen so quickly. So by every measure, this is unlike anything we've ever seen in the United States, outside of, maybe the beginning of World War II, but wars are different. And so none of the existing models are really adequate for understanding it. When people say, I have a 20-year time series, or I have a 10-year time series, or I have correlation models and regression models and so forth, I say throw them all out the window, because none of them capture what's going on right now. You'd have to be 95 years old or older to have a living memory of the Great Depression. So what we know about it is maybe we learned from our parents or our grandparents who studied it. There are a lot of resources. I'm not saying you can't understand it. I'm just saying that no one alive has lived through it, or very, very few. And as a result, I think that people don't really understand it. There's a lot of talk in the U.S. right now about what they call pent-up demand. And the idea is that, we'll have a V-shaped recovery. So the economy will fall very steeply, very quickly, but it will bounce back equally steeply on the upside and very quickly. And that's not true. It is going down quickly. That part's true. But when it hits bottom, and we haven't hit bottom yet, but when it does, it's much more likely to come back very, very slowly. Not at all fast, not at all strong, for a lot of reasons. Some of these effects will linger. The virus might get under control, but it'll still be around. But more importantly, behavior changes, and it can change for a generation or longer. I grew up in the 1950s. I did not live through the Great Depression, but my parents did, and my grandparents did. And as a young child, you learn from your parents' behaviors. And we saved rubber bands. We collected, the Boy Scouts would go out and collect tin cans and newspapers. And we weren't doing it for, environmental reasons. We were doing it in order not to waste resources. And people didn't spend much. They didn't expend extravagantly. They didn't overborrow. They didn't overpay. All that came later. That was much more characteristic of, say, the 1970s, 1980s and forward, but not in the 50s and 60s. So my point being, the impact of the Great Depression on behavior lasted for 30 or 40 years, through the 1970s. My view is that something very similar is happening right now. The impact of this on everybody, people losing their jobs, hours being cut back, people being ill, people dying, that this will last for a generation. It'll affect people alive today for the rest of their lives. And so, therefore, I don't expect a quick rebound in the economy. I expect a very slow, drawn out, and weak rebound. And then to the extent that there's any growth, there will be growth at some point, but it will be below the recent trend. I say recent. We had a 10-year expansion from 2009 to 2020, say an 11-year expansion. Average growth during that expansion in the United States was 2.2%. Average annual growth. But the average annual growth of all expansions since 1980 is 3.2%. So the recent trend is a full percentage point below the longer term trend. And my concern is that when we hit bottom, and we have not hit bottom yet, but when we do hit bottom and we start to grow, the growth curve will again be lower than even the recent trend. In other words, it might be 1.7 or 1.8%. So it doesn't mean no growth, but it does mean depressed growth. In effect, you're in a depression.